Start investing in gold and silver today at sdbullion.com and join the over 35,000 precious metal investors who have made the switch to the lowest gold and silver prices in the industry. SD Bullion recently claimed a spot on the prestigious Inc. 500, making them one of the fastest-growing bullion companies in the United States. With low bullion prices and over-the-top customer service, SD Bullion is setting the standard for precious metals transactions. Visit www.sdbullion.com today and start saving on every precious metals purchase you make.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, it's been quite an interesting last week and a half in the wake of the FOMC decision last Wednesday, a week ago here today. And obviously both gold and silver were hit pretty hard, but in the last day or so, they stabilized a bit. Earlier in the week, we had silver plunging again on the Japanese news, but silver has recovered pretty nicely, and gold also is trading back above 1130, trading around 1135 for most of the day today. Silver also trading right about $16 here as we record late on the 21st. So let's get your take here on the trading action, how the metals are looking here and shaping up as the Fed has finally hiked rates.
It's nice to actually see them hike, and get that thing behind us. I have a feeling that we're going to see a very similar pattern to what we saw last year when the Fed raised on December 16th. They did a quarter-point hike. They effectively only raised about 13 basis points or so. And they were basically forced to do that for a variety of reasons. And that's kind of where we are now. And they will be behind the curve when it comes to inflation and all of the monetary stimulus that has been dumped into the system. And then, you have the whole infrastructure plans and fiscal spending side of stimulus that will be coming when Trump comes into office. Certainly will not be as big as, some people have been hoping, but it's still going to be big enough, as well joined by other countries around the world doing things that are similar, such that we'll probably see a continued drift upward in bonds and pressure with the bond market, and along the same thesis that I've been talking about for many months now before the election too. And December has just been really choppy. We've seen this huge downdraft ever since the election, and interests that want the fiat paradigm and all that it represents to be maintained and protected are working overtime right now. I mean, we have on a very near-term horizon some kind of action out of Italy with respect to their banking system, and it really does look like policymakers are kind of trying to juggle many balls and scrambling and trying to do whatever they can to tweak policy, such as, the Bank of Japan saying that they're going to continue to leave policy in an accommodative stance, and then versus the Fed, kind of basically faking it, frankly. I mean, their whole posturing about about raising interest rates is something that they're being pulled by the market. The market is basically pushing their hands. And when you get those kind of differentials and the way that they move the FX markets, the foreign exchange markets, yesterday we saw an explosion of activity. The yen declined by about 1% at one point, and that just sent shockwaves all over the world. And there's been a lot of hot money flows diving into U.S. dollar-denominated assets. That's part of the reason why we've been seeing the Dow keep trying to bash through 20,000 on the upside. I think it's been reversed about 7 times, failing every time, in the last month and a half or so. And that's been really hard on precious metals, because when you look at things like yesterday with the FX market, the FX market's just giant. It trades like a notional value sometimes on the order of $6 trillion worth of trades in any given day. When it moves everything. And we've been seeing that play through this whole week. And silver recovered as strongly as it did after yesterday's trashing is actually an indication of how strong underlying demand is for both the paper traders who are, nibbling around the edges and beginning to get into positions even on the COMEX. And there's a lot of buzz within the alternative asset community focused on JP Morgan and their possible accumulation for their private client accounts. And we've talked a lot over the years about that whole thesis that Ted Butler has been putting out about how, JP Morgan is essentially accumulating physical silver and bashing the heck out of paper silver, and there's some truth to that. And even at a base level of interpretation, when you look at the holdings that JP Morgan has, the bottom line is that it's absolutely the case that they're physically accumulating metal. It's just a question of who's doing it and then what interests are represented there. I don't entirely buy the full scope of what Ted Butler's thesis represents, but anyway, the bottom line with the action that we've seen pretty much all month, even after the election and this whole period of insanity that we've seen ever since the November 8th election, still, by my mind, given how much the dollar has been moving to the upside, and given how much, there are every reasons that you would expect that to continue to push metals lower, the fact that we haven't completely crashed through 16 all the way to, a sustained downward move to retest the lows earlier this year, frankly, to me, gives me every indication that the market's a lot stronger than what it actually is showing. We see that action as well in miners. I posted a funny note last week talking about how I had sold a pretty large position for tax loss reasons, and it didn't even move the market. It was amazing. I'm not going to mention all that stuff now, but it's a long story. Suffice it to say, I think that we're seeing a repeat of what we saw last December, where the markets for precious metals were really weak. They were really beaten around. But in January, we recovered very strongly. And though it was only about half of the month in January that we saw the rebound, by the time we hit February and months thereafter, the markets continued to do that moonshot that we saw, the really strong first half spilling into, the summer of this year. And in the very least, I think we're going to see a repeat of that. But a lot more, frankly, because of what's going on with the bond market and the fact that I think the S&P 500 universe of standard equities within the United States and, small caps, Russell 2000, the entire equity market is going to roll over in 2017. And the primary catalyst for that is going to be the high valuations combined with rising interest rates, making everyone freak out. And that's unbelievably bullish for precious metals. So I think we're going to have an outstanding 2017, even though we have all this craziness and choppy trading that we're seeing and slogging through right now, and tax loss selling and all of that stuff. But I see a lot of accumulation at the same time that we're seeing this pressure in precious metals. I mean, we'd be a lot lower than we are right now were it not for the fact that a lot of people really do understand how unstable financial markets are, how unstable the banking system is, particularly in Europe, and that we see a lot of people running to U.S. dollar-denominated assets because local economies in Japan and craziness in China because of their credit market insanity and all that. That's not an indication that people love the U.S. stock market. That's an indication that they're scared to death about their own assets in their own countries. And yet, when the mainstream financial news talking has tried to analyze this stuff and put it out to their world in their quote-unquote fake news organizations, not us, them, they don't talk about, alternative perspectives on these kind of dynamics. And I think that we're more of the real news as opposed to our fake news comrades over at Bloomberg or whomever.
Yeah, and I'll add to your comments on the price thoughts that it's really an interesting time in the physical markets, and really brought on by it's been about 4 weeks ago that the U.S. Mint, the U.S. Mint, for those new to the market, they always shut down earlier than anybody else for the year. Usually about mid-December, they'll just shut things down for the year, and they'll say they're switching their dies over the next year's coins. Well, this year they actually made that announcement out of the blue in November, And it's interesting if you look at their sales numbers because last year in 2015, the Mint set an all-time record sales for Silver Eagles at 47 million coins. This year, they have sold just 37.7 million coins, so about a 20% year-over-year decline in Silver Eagles. And further on, we know that they weren't, let's say, out of capacity. They didn't shut down early because they were out of coins, because if you dig into the numbers a bit deeper, out of the 37.7 million coins that the Mint sold this year, about 23.5 million of those were sold in the first 5 months of the year. By the end of May, 23.5 million Silver Eagles have been sold. So the Mint's only sold 14 million coins the last 7 months of the year, which is quite astounding. Through the first 5 months, the Mint was on pace to shatter last year's record sales numbers. And now year-end, it's coming in a 20% year-over-year decline. And long story short, that's set somewhat of a shortage in the market here, as the Mint hasn't sold any coins in about 4 weeks. That has not resulted in a shortage at the retail level yet, but I can tell you from what we've seen at SD Bullion, any further price weakness in silver, and it could materialize rather rapidly, because what's happened is all the retail dealers have panicked and sourced inventory to try to cover themselves for the last month. So the retailers still have about a month's worth of inventory, but the wholesalers are all out, or basically on fumes. The president of one of the Mint APs we bought from, I think on Monday, told us they had 18,000 Silver Eagles. So we had more in our vault as a retail dealer than one of the Mint's APs. And they're restricting the dealers to purchases of 1,000 coins. I've never seen that since, I think, 2011, maybe 2013, when some of the wholesalers completely sold out and didn't have any coins. So a long story short, I mean, we're seeing it in gold too. The U.S. Mint has shut down their gold eagles, gold buffaloes, fractional coins pretty early. The same thing, the wholesale market is sold out of American gold coins, whether it's buffaloes, eagles. Gold maples are delayed anywhere from 2 to 4 weeks at pretty much all of the major wholesalers. There's really not any more inventory readily available for retailers to source if they see any sort of increased demand on the retail level, taking down their own inventories. So you haven't quite seen it yet at the retail level. For example, if you want to buy a tube of Silver Eagles from SD Bullion or one of the other online retailers, they're still available because they've all stocked up in a panic over the last couple of weeks. But we're not able really to replenish that inventory until the Mint releases 2017 coins, really not till a month from now in Silver Eagles.
Yeah.
So now if we do see the same type of situation like we saw last year, where silver and gold start moving higher, and demand over the next 3 to 4 weeks is somewhat subdued, and likely I expect it will be at least for the next week over the holiday. But you likely the supply chain will be able to get by. But if you had any further weakness, which is one of the reasons I think we probably won't, things could get disorderly rather quickly just due to the current unique inventory system in the market.
Yeah, and you know, when we were looking earlier in this year and we saw the authorized purchasers who would purchase from the Mint really just go bonkers and pad their inventory, if they standing with lean inventories now, and if we do see a pickup in the market, it really could end up being that they end up acting like afterburners because they want to be able to have the inventory on hand in 2017 to be able to capture rising premiums if, in fact, market takes off. So we have a setup for the possibility that January is going to be downright explosive, certainly by February even.
Yeah, it'll certainly be interesting. And, I mean, Again, it's hard to put into context because the numbers we've seen at SD Bullion have been continued strong retail demand. We saw all-time record sales in November. We saw just last Thursday, the day after the FOMC decision, when gold and silver were down hard, we had an all-time record sales day. I mean, almost doubled our record sales transactions. So you have to put it with a grain of salt. SD Bullion's in a growth stage and growing rapidly. But, I mean, everything we are hearing across the industry, the APs were saying that coins are flying off the shelves. Silver Eagles were flying off the shelves. Just another anecdotal story. We heard that there's one small, private New York bank that often goes over a year at a time without making any purchases and called and completely cleaned out one of the APs. So it's definitely interesting, and like you said, Eric, there's definitely the potential for some fireworks should we get any sustained or increased demand on the retail level here over the next 4 or 5 weeks.
Yeah, and this all kind of hooks up and is in sync and makes sense when it comes to signals that we can see even on a global macro front and looking at the entire world and what's going on with precious metals. I mean, we've had, for example, yesterday, China's premium in their exchange, $40 premium over spot in Western markets. We have seen, the ETF declines, the gold ETF holdings in metric tons just utterly be blown away in the last 28 days. They've dropped 28 days straight since the election. It kind of feels a little bit like what we were experiencing back in 2013 after that April period where on that Friday through Monday and particularly the Sunday thin market trading when some crazy bullion bank or other interest, and rumor was that it was Merrill Lynch, dumped in upwards of 400 metric tons of paper gold on a Sunday, with some of that on Friday and spilling over into the Monday morning to blow away the market. And over the course of the subsequent weeks, gold dropped $200+ and it was so insane that the ETFs, though the prices were declining and bullion was being pulled out of the ETFs, it was bullion that was shipped over to the Switzerland refineries, and we have, absolute confirmation that that was going on based on industry contacts that we would speak with, as well as other people in the industry doing exactly the same. They were running 3 ships and having record levels of conversion of those 400-ounce bars.
They're running 24/7 over in Switzerland.
Yeah, and here we are. We're recording today. We've seen the gold ETFs being obliterated for 28 days straight. That's the biggest decline on a sequential basis since 2004. I mean, we have premiums in China. They're pulling in gold like crazy. The government is freaking out about the fact that they're not able to really manage their managed currency peg, and to explain that to our audience that is not familiar with how that works, the Chinese government doesn't have 100% control over the currency and how it trades. They have a pretty darn tight control over it, however, and in layman terms, that's basically what the managed peg that they have as a currency regime ends up doing. But every once in a while, it just kind of goes bonkers, and they lose control, and they've got this problem with the the yuan declining faster than they would like against the dollar. Sometimes they like that, and they use it even to send messages to the Federal Reserve to back off on threatening to raise dollar-based interest rates, because that ends up hurting China and other economies around the world and whatnot. I mean, it's kind of a crazy spider web, bird's nest, chain reaction, multifactorial mess in terms of how those things play out in markets. But it really does look like there's a heck of a lot more physical demand than what meets the eye if one only looks at the declining prices of gold and silver since the election. The market's a lot stronger than what I think people give credit to. And in fact, yesterday is a nice little anecdotal example where silver got the snot kicked out of it, fell below 16 and tested 1550 and bounced all the way back by the PM evening hours in New York time. That kind of stuff on a thinly traded holiday weekend tells me that there's a lot stronger sentiment and a lot a lot of smart money buying right now. The stuff that I see in the mining sector as well is confirming that to me. So I actually look at what's going on now as indicating that we're going to see a really great setup for 2017, and I'm really not too worried about the fact that, yeah, we can see, in fact, the next week and a half or so of trading with through the holiday and all that look really ugly, really sloppy. Probably scare the heck out of a lot of people too. But the fundamentals for the precious metals remain stronger than they have been all year. And then we have this craziness going on with our credit markets and, Italy on the horizon and on and on. So,
yeah, let's talk a little bit about Italy and how that might be not only influencing or perhaps a little bit of the motivation to smack gold and silver down here recently, as well as the risk for the banking sector over the next few months.
Yeah, well, Monte dei Paschi is basically bankrupt, and they're trying to convince their bondholders or other new investors to buy into bank shares of the bank to reliquify the bank. But no one wants to do that. They don't want to buy the garbage, and that's totally understandable. So the Italian government is sitting there wondering what they're going to do, and it's probably going to be a combination of things, actually. But, what people are talking about is bail-in of deposits, partial bail-out of the rotted balance sheet as well, too, by the taxpayers, maybe the ECB. In fact, highly likely that the ECB, in fact, more I think about it, is actually the ECB would have to directly participate in that kind of a, bailing out. And who knows, maybe we might even see swap lines, for example, with the Federal Reserve swapping dollar-based assets in exchange for the ECB sending over euros, and then the ECB is a more liquidized position to be able to deal with bailouts and all that kind of stuff. And we've seen that periodically since the 2008 crash. So all this
and any of those scenarios, you would have to imagine, would trigger demand for gold as well as silver across the EU.
It would. And in fact, it probably is right now, and it's just being overtaken by paper market pressure in the futures markets. Nothing new there. We've seen that countless times. In fact, it's really just kind of bizarre that ever since we have seen stepped up manipulation of markets, anytime you see anything, even on a geopolitical front where something just, like we had a terrorist attack in Germany. Normally, in a normal world, gold would go up. Every time we have major things that are going to be catalysts, like even the Brexit vote, gold went up a lot, and then eventually the powers that be that are concerned in keeping the fiat paradigm humming very nicely without having banking systems implode and on and on. They beat the crap out of gold because they can. But their ability to do that is not indefinite.
There's two classic examples in the last few years that stick out in my mind. And that was when the Swiss broke the euro peg a couple of years back. Gold immediately started to spike and then was instantly hammered, I think about $75 counterintuitively. And then the other one was when I think it was S&P who downgraded the U.S. a couple of years back, and instantly over the next couple of days, gold was hammered again counterintuitively. I mean, the U.S. is downgraded by one of the two major rating agencies, and gold gets hit. Right.
Now, before we leave the banking system issues in Italy, today we saw the TLT long and Treasury bond ETF, and that holds an average duration of bond holdings that approximates a 20-year bond. And that puppy saw some huge buying for, expectations that the 10-year U.S. government bond would fall below a yield of 2%. And if that, and the notional value of those trades were about $1.3 billion for a February payoff, if in fact the calls were to make that a profitable trade. I didn't look up actually what it cost to, in fact, put on those trades. I'm speaking only of the notional value. But regardless, that's a hell of a lot of money, and it just shows that when people see that, they might think, oh, okay, people are not worried about rising inflation or rising interest rates, and that's why people would put on a bet like that. No. What that bet shows is that people are actually looking at the financial world, looking at the mess in Italy, and they're actually placing Hail Mary bets to capitalize on the possibility that we have a financial implosion, deflation within the financial sector that spins out of control and makes everyone run to the U.S. bonds because that, it provides a short-term kind of protection. I mean, people in the audience think back about, since the 2008 crash, we've seen bond yields go down, 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 down as we created the biggest bubble in financial history in the bond markets. And here we are again where, there are some traders out here who are looking around at craziness with this thing with Italy on the very near-term horizon, and they're actually willing to put real money on the table to bet that we have a deflationary crash in spite of the last period since the election where we saw, 70 some odd basis points added to the U.S. 10-year Treasury bond as people were pricing in a return of inflation in the real economy on expectations that the infrastructure spend, a la Trump, et cetera, would, create rising bond prices and the end of the bond bull market and yada, yada. People talking about the 35-year bond market dying. The 35-year bond market is over. Bull market is over. We're in a bear market, but we might actually see an intermediate period of a couple of months where markets just freak out because we have a financial deflationary wave as the rotten balance sheets in banking systems implode. And what happens after that? Well, we already know that the central bankers will respond to something like that because that's their mandate. They protect the banking system. It's not about the dual mandate of the Federal Reserve with, trying to keep inflation prices stable at 2% and shoot for some magical unicorn, quote-unquote, full employment number that's complete manufactured nonsense, given the way our government, tabulates unemployment rates. With decades of watching financial markets under my belt, I've never seen anything as insane as what we're facing right now. 2017 is going to be a year where things break. And we can debate about what breaks and how things break, but things are going to break. And, just to put everything into context in terms of how much central bankers have been working their rear ends off to try to save this financial mess that happened ever since our crash in 2008, the ECB now has on its balance sheet the equivalent of 35% of the gross domestic product of the entire Eurozone economy on its balance sheet and the assets that it owns. And, the ECB controls 9.2% of all European corporate bond market debt. It wasn't all that long ago that the ECB wasn't even legally able to buy corporate market bonds. That's how insane everything has gotten, where we have these central banks acting in concert with government and private banking interests to try to prevent a total disaster of a deflationary crash that clears markets. We no longer have real markets. We have artificial Frankenstein monster beasts and people, policymakers, that believe that they actually can juggle all of this stuff. And that's why I say that, as I look at where things are, as I look at the bond market beginning to back up with interest rates rising, despite the short-term risk of some deflationary fear, if we have a wipeout in Italian banking sector or whatever, we're going to see interest rates continue to rise on the long end of credit markets because the ability for all of these hubristic, overconfident, academic policymakers to actually achieve what they think that they can, informed by their models and all of their understanding, is in fact not going to work. And we're already beginning to see the markets begin to break away from them. We've had this super long duration of the standard S&P 500 universe of equities do really well, and corporate profits fall off a cliff basically ever since late 2014. Lots of ETF and insider activity and the purchase of insider or I shouldn't say insider, but the corporate treasuries of large corporations borrowing from the credit markets at super subsidized rates to go and buy their own shares. We've seen over $1 trillion in the last couple of years of stock market demand coming from just that source alone. Everything is so artificial and so unstable. And I think 2017 is going to be the year where things fall apart. And I should also remind everyone as well that, listen to our podcast over the years. I don't consider, the scope of what we've been talking about as, I have not been a perma doomer porn kind of an analyst when I look out at all of the various fears that people have brought to our alternative asset space, whether it's the Greek crisis or Shimitar or whatever. And every once in a while, the alternative asset community just kind of falls off the turnip trike and exaggerates the potentiality of certain catalysts for falling into place and making markets just unravel. But this time around, I think the bond market is really going to serve up the Black Swan that people truly don't see how significant it'll be at this stage, but they'll start seeing it in the end of the first quarter of next year when interest rates begin to move higher. And I think that's going to upset the financial markets and create what will be the final stage of the precious metals bull market asserting itself, and we'll have a blow-off top even in the months and year or two afterwards. It's going to be a great time for precious metals markets, and the only thing that it actually scares me that I have on my longer-term watch list in terms of what could stop it is what governments might do to try to fix things, quote-unquote. We see all the insanity in India, for example. In fact, I think part of the reason why they're cracking down on India right now is because it's an effort to try to get in front of exactly what I'm talking about.
Yeah, I couldn't agree more. I mean, it's pretty clear that India seems to be a trial run for the war on cash, which will likely escalate into the war on gold.
Yeah.
And if India is any indication, official prices might not go up. I think in India right now, official gold prices are about $1,200 per ounce if you're looking online at the tickers. But try being in India right now and buying an ounce of gold with rupees, and you're looking at $3,500 to $4,000 equivalent per ounce due to the devaluation of the rupee currency as the government has attacked the currency. So.
Yeah, and they also went after the 1,500 rupee notes for not just reasons of going after cash generically, but it's also a roundabout way of them attempting to control the flow of smuggling purchases for gold. Because, well, if you don't have a lot of cash laying around to be able to purchase gold as your escape hatch, then you just aren't able to buy it, whether it's smuggled or not. But even so, right now, I think we're looking at an annualized run rate of maybe 500 metric tons of gold flying into India illicitly through smuggled channels. That's a heck of a lot of gold. I mean, India kind of cruised along at about 800 to 1,000 metric tons annualized purchases of official gold in recent years, and 500 metric tons going underneath in back channels, despite the fact that the Modi government is trying to stop things, is a heck of a lot of gold. A lot of people are buying silver as well, too. We talked about that with Kranzler last time we had him on the show.
Yep, certainly. Well, once again, Eric, so much for an abbreviated, shortened show. I think we put in a full episode again, so we'll wrap things there.
You get me going. we were trying to do a holiday short show just so that you can take off and whatnot. But our listeners, if you want to check out a recording that Jason and I did, Jason and I talked a lot about what happened with Japan's currency machinations yesterday, and it builds on what Doc and I are talking about today. So it's up on the site, and there's other great articles and content up on the week. But we're going to take off for the vacation for now.
All right. So on that note, thanks for tuning into this week's SD Weekly Metals and Markets.